Hello and welcome back to our next installment of our market update video series. First, some careful planning that can save you thousands on your Medicare premiums, and second, navigating risk in the portion of your portfolio that you think is safe.
Thank you, Danielle. I understand that you have secured your spring internship with NBC's investigative unit.
Yes, I have.
Well, enjoy yourself at 30 Rock and enjoy yourself on the Long Island Railroad, which I'm very familiar with. Obvious dad plug on the internship.
What should all Medicaid-eligible individuals be aware of as it pertains to the tax code and the dreaded Medicare premiums?
Well, Danielle, clients should be thinking about how they should manage their income and use the tax code in their favor to make sure they are not subject to higher Medicare premiums. I want to first start by explaining the cliff. As shown by this chart, I will show how without proper tax planning, someone could be paying more on Medicare than what they should. To illustrate this issue, take a hypothetical scenario of a couple who is married and files a joint tax return. If their income is below $172,000, their premium for Part B will run about $144 per month per person. However, if they earn $1 more, their premiums go up significantly to around $214.20 per month per person. That is a 40% increase in what they would pay per year on Medicare just by having $1 more of reportable income. This is what we refer to as a cliff. For a single filer, the cliff begins at $87,001.
That is a pretty big jump. So you mentioned tax planning before. What are some potential action steps clients can take to avoid paying more to Medicare?
Well, Danielle, there are a couple strategies that clients can consider to help reduce their income so that they don't go over the cliff. Charitable giving, contributing to 401k plans, traditional IRAs, and HSA accounts that could potentially reduce their taxable income, making charitable contributions from their retirement accounts if you're over the age of 70 and a half, and finally the use of Roth money or after-tax money in instances where you would otherwise use your regular IRA or 401k. In any case, you know that we here at DLAK are prepared to address this important planning step so that you don't pay any more than you have to for your Medicare coverage.
Now let's turn our attention to a topic that surprises many investors in regard to money they consider their safe money.
As of the taping of this video, Congress has just passed new laws that will impact required minimum distributions. So I do want to ask you all just to stay tuned. And I have one other piece is I think many of you were expecting, if not hoping, that part of this video would be speaking to the landscape of politics and how it's going to impact decision making on the investments. I do promise you this. Yeah, when we're together, we'll probably have more personalized conversations around the matter. But I cognitively and continually will be paying attention to the sectors that get impacted by the makeup of Congress and the makeup of who's sitting in that executive chair. So whether that impact will be positive or negative for healthcare or technology or financials or alternative energy. Stay tuned on that matter. Thinking about the responsibilities to our clients. Danielle, I wanted to address the whole concept of what risks am I taking versus what rewards should I expect. Many investors don't realize that even the bond component of your portfolio does have risks that are important to consider in managing one's investment portfolio. While it is true that bonds are categorically less risky than stock investments, they do have risks, if not significant risks, that we always must be aware of.
What are some risks that are unique to bond investing that you're focusing on right now?
Right now, there's probably two things I think would be very helpful for today's discussion. First is interest rate risk. I want you to stay with me here because 2019 was sort of a year that could throw you a curveball on understanding the risks that exist from an interest rate standpoint. The example I want you to stay with me on is just say, for example, a 10-year bond was yielding 2% and a 1-year bond was yielding 1.5%. What is the likelihood that you would tend to lean more towards the attractiveness of that 2%, knowing that you'd have to lock your money up for 10 years rather than having it relatively liquid and being available 1 year with only 0.5% less in return on income? 3 quick points in the past. Between 1978 and 1980, the 10-year Treasury yield went from 7.5% to 11.5%. From 83 to 84, the 10-year went from 10% to 14%. And from 1994, it went from 5% to 8%. Let me tell you what that means in a mathematical sense. Every 1% rise in interest rates is going to be multiplied by something called a duration. Say that a 10-year bond or your bond mutual fund has a duration of 5.5, which is around what many of them have. If interest rates were to go up 3%, that would mean you have a 16.5% drop in your principal. So let's take just one of these examples. So let's take the 1978 to 1980. You received 15% in interest, over that 2-year time period. But the 5% rise in interest rates, your principal would have dropped 27%. So the point there is long-term bonds at this point in time is something that will play a very small piece, if at all, in your portfolio due to the importance, as I noted before, of minimizing risk. Second piece now is going to be known as spread risk. Spread risk is going to mean something along the lines of, what can I do if I chase yield? Chase yield could be high yield bonds. Chase yield could be something known as floating rate or bank loans. Let me give you an example of today. For the past 10 years, the high yield bond index has averaged almost 10% per year. The current yield on that index is barely above 5%. Floating rate, you've made close to 6% per year over the past 10 years. Once again, the yield barely being above 5%. Let me give an example also on both of those different types of securities. In 2008, the high yield index dropped 26.16%. In 2008, the leveraged loan or bank loan index dropped 28.75%. So that being said, there are going to be times when we're willing to buy low with the expectation of selling high. Always being cognizant of doing everything within our power to not buy high. Clearly, our responsibility is to understand that when we put 10%, 50%, 70% of your portfolio into bonds, our primary directive with that money is to do our best to protect you, minimize volatility, and to be honest, not lose your money. Although it is widely publicized that timing the market is impossible. Why? Stocks do not have a par value. Bonds do. Bonds also have a defined maturity, which makes it easier to anticipate when could be a good time to buy low and when's a good time to potentially sell high. We never want to get caught up in chasing a higher yield without addressing these risks. Our number one responsibility with bond investing is to ensure that the money is there when it is needed.
And thank you for joining us today. I would anticipate that given 2020 is an election year, you will see us again in video in the not too distant future. Until then, we thank you for the trust you've placed in our organization. We wish you all a success in 2020.